Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. With so many Australians in lockdown, the hit to the economy continues to grow. And unfortunately, the COVID-19 case numbers show no signs of abating, which means our two largest economic hubs, Sydney and Melbourne, will likely stay in hibernation until vaccine levels hit at least 70%. I wanted to get a clearer picture of what this all means, where we might be heading, and whether there's any cause for optimism. Gareth Aird is the head of Australian economics at the Commonwealth Bank. Gareth, welcome to Fear and Greed.
G'day, Sean. How are you?
I'm well. Now tell me, just how big is the economic impact with all the lockdowns? The ACT, of course, is in lockdown too.
Well, it's big, and it seems to be getting bigger based on the number of people that are locked down. In a way, you can sort of think about the economic hit as being a function of the number of people in the country who are in lockdown, and that number has been growing, and more than half the population at the moment is in lockdown. So what we're going to find is that the hit to GDP in the third quarter of this year is very, very big. It's going to be conditional on what happens with the lockdown from here. But I think we're looking at a really significant hit now to the economy, both from a production and also an employment perspective. And I think in New South Wales, we're going to be in lockdown here in Sydney until the middle of the fourth quarter. So it's not just an economic hit that's going to occur over the September quarter. I think it's carrying on to the last quarter of the year.
Okay, so this third quarter, the current one, are you looking at a contraction of what sort of level? And then what are you thinking about the unemployment rate?
So in late July, I put out some updated economic forecasts, and in there, an underpinning assumption was that New South Wales, or Greater Sydney rather, was in lockdown until the middle of the December quarter. That felt like a sort of a big call at the time because there was still some optimism out there amongst a lot of people that COVID cases might come down such that New South Wales would be able to exit the lockdown. But I thought the numbers were going to keep trending the way they have. That means that policymakers will just not be willing to reopen the economy until around that 80% vaccination rate. So look, I've got in there a contraction in GDP of 2.75%, but I think the risk is that number's getting bigger because I wasn't thinking that Victoria would be in an extended lockdown, but that's what's going on now. I mean, the weeks are all adding up.
Yeah.
And so I think we could be looking at a hit to GDP of well over 3%, which is a massive contraction in economic activity.
And that means job losses?
Yeah, absolutely. I mean, especially here in New South Wales. I mean, it's worth keeping in mind that a lot of these jobs will come back when the economy reopens. But if we're not exiting lockdown in Sydney, for example, until the middle of the December quarter, then a lot of people are going to find that they haven't been working for many months. And I think we're looking at a hit to employment of around 300,000. It's not going to show up in the labour force figures for July, which come out on Thursday. It'll be picked up in the August and September figures. But there's probably around 1 in 10 workers in Sydney that are stood down at the moment. And because we don't have the JobKeeper payment mechanism in play at the moment, which kept people tied to their employer, and from a statistical perspective, it kept them, quote unquote, employed, all of those people that are stood down at the moment will not be considered employed. So we're looking at a big hit to jobs. We'll get a lot of those back, but I think that when we come out of this, things are going to be a little bit more bumpy than what a lot of people are expecting.
So could we end up with a double dip recession, at least technically a double dip recession?
It's probably going to be hard to end up with 2 quarters of contraction in the economy simply because the fall in economic activity in Q3 is going to be so big that as long as you get some reopening occurring in Q4, you're going to get a positive growth rate. But I think that's sort of a little bit misleading in terms of what overall is going to happen. I think what will happen is that we get a huge negative hit to Q3 and we only get a partial rebound in the December quarter, which means the economy in the December quarter will be smaller than what it was in the June quarter.
Yeah.
And I think if you couple on that all the job losses that will take place, I think what we're going through is effectively a recession again. It's just that we may not end up getting those 2 consecutive quarters of negative growth.
And I mean, Commonwealth Bank has access to an incredible amount of data around consumer spending. Is that reflecting what you're talking about?
Absolutely. And look, it's intuitive, really. If households are told to stay at home and a lot of businesses can't open because you're trying to limit the spread of COVID, then you naturally are going to get a hit to spending. And it's all showing up in the services sector. So our internal data suggests that spending so far in the September quarter, and we're about 6 weeks in now, is 10% lower than what it was in the June quarter. That's a very big hit to spending. Now, it'll look a little bit better if Victoria can come out of lockdown, but if they don't, and based on how our data has been tracking, then consumer spending is going to be down somewhere around that magnitude in the September quarter, which is a huge hit. But it's exactly what you'd expect given households are encouraged to stay at home, and that automatically then limits the amount of money that you're spending.
Stay with me, Gareth. We'll be back in a minute. My guest this morning is Gareth Aird, Head of Australian Economics at Commonwealth Bank. So when it comes to monetary and fiscal policy, over the last 24 hours, the minutes of the Reserve Bank board meeting came, and it certainly has left the door open to do more on the bond purchasing side to keep longer-term rates, or a lid on longer-term rates. But the heavy lifting has to be done on fiscal policy. So do you think the government will come in and have to step in and prop up the economy again?
Look, the government, both state governments and the Commonwealth, are providing a lot of support, but I think there's scope to provide more than what is currently being injected, particularly into businesses. It's probably worth sort of thinking about the policy response to what we've been going through. And it was assumed initially that the lockdown in Sydney would only go on for a couple of weeks. Then that was rolled out, and sort of the time frame of which policymakers have expected we'd be in lockdown has continued to grow. And so the support packages have sort of evolved, but to me, they're still not at the point where policymakers are assuming that Sydney, for example, is in lockdown and for several more months. And a similar sort of situation in Victoria, to the extent that each week you're in lockdown starts to add up, and then you look at the policy response and say, well, is it really appropriate now for how long the lockdown is actually going on for? So I think there's definitely scope to do more. And I would also suggest that businesses are going to need assistance when we come out of this, when the lockdowns are over, particularly here in New South Wales, because when the economy's finally reopened, it's not going to be on zero COVID cases. It's going to be on a vaccine threshold being met. And that means that COVID is going to explode, and we're going to be looking at a very different environment where we're learning to live with COVID. And I think that's going to mean that the snapback in spending that we've had coming out of previous lockdowns can't be taken for granted. And in particular, I think that there's a concern for a whole lot of businesses in the CBD, for example, because we could come out of lockdown and restrictions are eased, but a whole lot of workers don't want to return to the office because COVID's circulating, and that's going to have a negative impact on all those businesses in the CBDs that rely on workers coming into the office to work. So I think there's definitely the case to be made that the government needs to not only do some more, but also keep it going when we come out of the lockdown.
I mean, that's where your view, Gareth, isn't quite consensus, because so many economists at the moment are just saying there's pent-up demand. What happened last year will happen again this year. Suddenly everyone will start spending as soon as it's all over. But the point you're making is really interesting. We're not coming out of this with zero cases. We're coming out of it with a new world.
Yeah, look, it's funny as well, because through coming out of the lockdown last year and the economic recovery, I mean, the whole time we were above consensus saying that the rebound would be very sharp, very strong. The recovery will surprise people because of how much money is sitting there. And if we can get on top of the health outcomes, then spending outcomes in the labour market and whatnot will all look very good. But this time around, I'm sort of thinking that when we come out of this, we're coming out to a very different environment, and one that we're not used to. And I don't think households and businesses are really conditioned to, and that is that COVID will be with us, and we're going to have to learn to live with it. And there'll be some teething problems, I think, with that. And we're already hearing from some state premiers that if New South Wales comes out of lockdown and COVID is circulating a lot, then they will keep the interstate borders closed. So I think it's all going to be a little bit piecemeal when we come out of this. I think initially there'll be a decent proportion of households that are hesitant to go out and do things, even though a lot of people will be vaccinated. COVID's going to circulate, and I think it might take us a while to get going again. I do think next year will be very good as far as the economy goes, but we're probably, I think, looking at a sort of 3 to 6 month period where, as a country, we adjust to living with COVID and what that means, and therefore I think there's some economic implications of that.
So transferring that to what it means for our wealth, and the two big areas of wealth, share markets, most of us for our super funds, how you think that's going to happen, share markets and house prices. What's your take on those two areas?
Look, it's not my domain to have a view on the equity market, but all I would sort of say there is that the equity market is very forward-looking and is probably more focused on the medium to longer-term picture. I think as far as the housing market goes, it's been incredibly resilient. And I think we're now sort of 8 weeks or so into various lockdowns around the country, and prices are still rising, lending growth is still pretty strong. And I think households by and large have kind of looked through the lockdowns, and they're also focused on the medium term. They know interest rates are very low, and it's not what's going on in the economy in the short run is not really having a negative impact on what people are willing to pay for a home. So I think by and large, property prices are going to be pretty much not impacted by the stuff that I was saying about the economy in the short run. I think that interest rates will remain the dominant driver of what people are willing to pay for a home. And because I think interest rates are still going to stay very, very low for an extended period of time, people will be confident to transact in the housing market.
I mean, while I have you, Gareth, and before you go,
Mm.
the commodity sector is a really interesting one at the moment, and there's lots of M&A activity going on. Just parking that. Iron ore kind of, not that it saved us, but it certainly helped the Australian bottom line. That's come off. The price of iron ore has come off. What's your prognosis for some of those commodity plays?
Look, it has come off a bit, and it basically had to. I mean, it was so elevated, and there were, for a variety of reasons, but the supply side had a big impact there. We've got a commodity strategist at the bank in the research team, and he's of the view that commodity prices are going to be trending down from here.
Mm-hmm.
They're coming off very elevated levels, I should add, but it does mean that as they come down, that the terms of trade comes down, and that ultimately weighs on our national income. So to your point about the budget has had a complete windfall from what's been happening in terms of commodity prices, particularly iron ore. But I think we've seen the best of it, and I think we can expect commodity prices from here to trend down, and that ultimately will mean that we're running smaller trade surpluses, and it will mean the windfall that the budget was getting, they're still going to be well supported, but ultimately we've seen the best of it.
Gareth, thank you for talking to Fear and Greed.
Nice to have a chat.
That was Gareth Aird, Head of Australian Economics at the Commonwealth Bank. This is the Fear and Greed Daily Interview. Join me every morning for the full Fear and Greed podcast with all the business news you need to know. I'm Sean Aylmer. Enjoy your day.